Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, it was a very up and down week on Wall Street, down at the beginning, a large 240 point drop for the Dow on Monday, and then followed by 4 days of a real rally that saw the Dow shoot up well over 600 points in those 4 days. There were a number of catalysts for this. Firstly, there was really the Federal Reserve Chairman Ben Bernanke giving the market some hope for another rate cut at the next Fed meeting. This would, of course, help to support the economy. Also on Thursday, gross domestic product figures showed that the third quarter still grew at an annualized rate of 4.9%, which was probably better than most people had hoped. The third thing, of course, was the falling price of oil during the week. That dropped back to $90 a barrel or so at one point, and when you consider that only about 10 days ago it stood at 98.4, that's quite a drop back. Well, will this rally continue into next week? Will this be the end of year rally? That's quite often the case in December. We'll have to wait and see, of course. We're going to look at the various scenarios that are playing out now on the Nasdaq Composite Index chart, just to see where the market may be heading. Here we're looking at the Nasdaq Composite Index chart for the last 3 years. The reason I want to look at this chart today is to really point out the importance of this long-term average line. This is the long-term average over these last 3 years, and the significant thing is that the market really for the last year and a half has been well above that average line, taking now 3 tries at breaking through the line, and each time bouncing back very nicely, and in fact reaching the October highs we've seen last month before the last selling period. The selling that happened a few months ago, of course, was when the first news of the subprime mortgage crisis broke, and considerable selling at that time took us virtually down to touch that average line. We now have another sell-off period going on. Last week, of course, we had a nice bounce back, with the feeling that the Federal Reserve may well cut rates again at the December meeting, but also a little bit more confidence that the financial sector is dealing to some degree with the financial crisis caused by the subprime mortgage industry. Now, the real question, of course, is whether this is going to be just a repeat of the pullbacks we've seen in the last year and a half or so, where this rally would now carry on upwards and go on to form yet one more high in this bull market that we've seen for the last 6 years, or whether, which is in our view more likely, that this is in fact the short-term rally which will be part of a right-hand shoulder forming out here of a head and shoulders pattern. This head and shoulders reversal pattern really is the left shoulder here, followed by the head of the pattern, which was in October, followed now by the formation of a right shoulder into the new year, before then, if the pattern does complete, the more likely scenario then is that the market will then drop down through the long-term average point at around about 2,500, 2,500 for the Nasdaq, and then possibly a longer term period of downtrend well into the new year. Well, that deep low on Monday officially branded the market movement over the last few months as a 10% correction. Normally this is the definition of a correction, that the market moves 10% off its recent high. So we've now officially got it. This is supposed to be a correction. We don't think it is. We think it's actually an intermediate low, which is actually the start of a right shoulder forming in a head and shoulders reversal pattern. We feel this for a number of reasons, but we're already well on the way to forming that right shoulder.
We feel there may be a little bit more in the rally to come to get that third peak, the third in the trilogy, which forms that head and shoulders pattern, before it then starts to fall away again to a more prolonged downtrend pattern. We don't like to be the harbinger of doom and gloom, but we do think that this is more likely to be the scenario going forward than a brief correction and then blasting ahead to new highs by year end. When you think that globally banks have written down 80 billion in securities linked to the subprime crisis, how much more bad news is there on the bank's books? We really don't know, and uncertainty is always the main enemy for the stock market. We'll have to see how things go by year end. Until next week, though, it's goodbye from London.